Hello everyone, this is Kevin Zhao, your finance professor at MTSU. In this video, we'll go through chapter 14, free cash flow to equity model. So what is a free cash flow to equity and why do we need to use free cash flow to equity model? Well, previously we did dividend discounting model, assuming that stock price equals discounted dividends company will pay in the future. That's a pretty good model to utilize. However, in reality, you see a lot of companies don't pay dividends. They didn't pay dividend during the last 10 years. It's unlikely they will pay dividend for the next couple of years. So how do you estimate future dividends? Also, eventually, stock price is the present value of dividends the company will pay in the future, but you don't know when that will happen. So here's an alternative that you can utilize to do cash flow based discounting model for stock valuation, and that is a free cash flow to equity. Free cash flow to equity is the cash belong to shareholders. It's also, although it's not paid through dividends, but it stays at company. It's like the money in the bank. It's not in your pocket, but still your money. It's not distributed as dividend, but it will be the cash that you will be getting in the future, sooner or later. That is free cash flow to equity. So free cash flow to equity is the cash flow belong to shareholder, held by the company right now, and that is part of your wealth when you invest in your stock. So it's a really good source of cash flow for you to estimate stock valuation. How do you estimate free cash flow to equity? Well, you have four items to consider. First one is net income. Net income is the source of cash belong to shareholder. Then minus the necessary capital reinvestment, and that is capital expenditure, plus depreciation and amortization. Why plus? Because depreciation and amortization was excluded from calculation of net income, and when you look at a cash flow, you need to add it back. And also the difference between capital expenditure and depreciation and amortization, that is for the net capital reinvestment. And another part of investment involves investment in working capital, that is changes in non-cash working capital. And the last item is change in debt. So 4 items for you to consider when you need to estimate the free cash flow to equity. When you solve problems in this chapter, you needed to establish tables in the Excel spreadsheet. In your Excel spreadsheet, make sure you have all 4 items before you reach the estimation of free cash flow to equity. So no matter it's a constant growth model or 2-stage model, the first thing that you needed to do is to estimate free cash flow to equity. And your first item would be net income. Second one, capital expenditure. Third one, depreciation and amortization. Fourth one, changes in working capital. And the last one is changes in debt. And here is, here's another equation for equity reinvestment. Equity reinvestment equals capital expenditure minus depreciation and amortization, which is net capital expenditure, plus changes in working capital, that is investment in working capital, and minus changes in debt. That gives you the number for equity reinvestment. And equity reinvestment rate equals equity reinvestment divided by net income. And this equity reinvestment rate is very critical for you to estimate the growth rate of the company, because the growth rate of company equals reinvestment rate times ROE. And in most cases, company will finance future reinvestment not only through equity financing but also through debt financing. It's very likely the reinvestment will happen through a mix of equity and debt financing. If that is the case, we needed to make a little adjustment in estimating FCFE by adding this delta. What is delta? Delta is debt ratio. debt ratio. That is proportion of investment that's going to be raised from debt finance. And you add 1 minus this delta on the net capital expenditure as well as the investment on working capital to estimate this FCFE. Or alternatively, because this 1 minus delta term will lead to same equation like this. Right. Changes in debt is because the changes in debt is due to your investment through debt finance. It's the same as this equation. When we compare dividends to free cash flow to equity, you often find that free cash flow to equity is greater than dividend, and the company does not pay available cash back to shareholder for many reasons. And even when you look at a dividend payout ratio, nowadays you really want to make little adjustment because a lot of companies does stock repurchases, so it's better to look at cash to earnings ratio, which incorporates both dividends and stock repurchases. And even when you consider dividends and stock repurchases, you see that a lot of companies still keep cash in their corporation even after dividend payments and stock repurchases. So for a lot of companies, it's better to consider this free cash flow to equity rather than the sum of dividends and stock buybacks when you do stock valuation. So here are 5 major reasons why company pay less than what's available. What's available here is free cash flow to equity. What they paid out is dividend plus stock repurchases. So we have 2 major models to utilize. First one is constant growth model, just like a DDM or FCFE model. And the cash flow here is free cash flow to equity for the next time period. And then you divide that number by the difference between cost of equity and the growth rate. Very simple equation. And here's a little more detail that you need to address, which is associated with this G, because this G would be very sensitive to your stock valuation. And we can look at the fundamentals of G in our analysis. And G has to be earned. Remember, G has to be earned. It equals equity reinvestment rate times ROE. And here, equity reinvestment rate equals equity reinvestment, which equal to capital expenditure minus depreciation amortization plus change in working capital and minus change in debt. That would be your equity reinvestment. Then divide that number with net income, you get RIR, or equity reinvestment rate. And you multiply this with ROE to get an estimation of G. Non-cash ROE actually exclude cash in calculating this ROE, which equals net income minus income from cash holding divided by equity minus cash assets. I mean, for most companies, you don't need to worry about this because companies typically don't hold a lot of cash. But nowadays, you see a lot of high-tech companies, some companies in other areas do have large amount of cash holding. If that is the case, then we have to use this non-cash ROE, net income minus income from cash holding, divided by equity minus cash assets. You may ask why companies getting income from cash holding, because when company holds cash, it generates zero return. That's what's supposed to be. But nowadays, a lot of companies actually hold a large amount of cash. They do not put cash in the checking account. They put cash in the money market instruments, which earn non-zero return. It's not zero. It could be low, but the risk-free rate, let's say short-term treasury securities, which generate 1% or 2% return, that is income that company can get from cash holding, or even in money market account, they can get 0.5%, 0.7% return. So companies do generate the income from cash holding, although it's a small amount. relative to its principal. And for two-stage model, it's very similar to the two-stage models in FCFE model or DDM model. We simply look at two stages company will go through: high growth time period versus constant growth time period or terminal time period. And we estimate free cash flow to equity during both stages and discount those cash flows back to today to get stock value estimation. And for second stage, we use golden growth model. Okay, we have one. We have one example to demonstrate. That is a two-stage FCFE model. Inc. That is a pharmaceutical company. For this chapter, I also want all of you look at 3 video demonstrations, problem solvings of 3 problems in this chapter. Question 3, and question number 3, number 5, number 7. In the end of chapter, question problems, and I developed Excel spreadsheets and showing you the details on how to solve those 3 problems. I think all 3 problems use 2-stage models, and one of them actually use 4-stage models. And I really want all of you to look at video demonstration as well as solution of those problems. And here in this video, I only show you one pretty straightforward example: valuing Amgen, a pharmaceutical company, using 2-stage FCFE model. Okay, let's take a look at some basic information on this company. This company had earnings per share in 1995, $0.95, capital expenditure per share of 40 cents, depreciation per share 32 cents, and revenue per share $7.45. Then we assume that the length of high growth time period is 5 years, and the return on equity was 21.74%, given 100% retention ratio. The expected growth would be 21.74% for the high growth time period, but this number cannot last forever. For the constant growth time period, expected growth rate will decline to 6%. Right? That's growth rate. Now let's take a look at cost of equity. Cost of equity would be different for those 2 stages. During the high growth time period, the beta is supposed to be higher, 1.3, based on 1.3 beta. The cost of equity during high growth time period would be estimated at 13.15%, given 6% risk-free rate and 5.5% of equity risk premium. We also assume that capital expenditure, depreciation, revenue are expected to grow at the same rates as earnings. So for high growth time period, that would be 21.74%. But for constant growth time period, that would be 6%. The working capital is expected to be 20% of revenue. That ratio 9.55%, and we expect this number will remain the same. For the stable growth time period, beta will decline to 1.1, therefore cost of equity will decline to 12.05%. Capital expenditure depreciation is assumed to be continue growing at 6%, which is consistent with earnings growth rate of 6%. Working capital remains 20% of revenue, and that ratio will not change. So those are basic information about the company. Now let's do evaluation of the company. Let's first of all look at the terminal value. Let's say terminal value equals expected earnings in year 6, then divided by R minus G, and expected earnings in year 6 equals earnings in the 5th year times 1 plus the growth rate, then divided by growth rate, cost of equity of 12.05% and a growth rate of 6%. That will give you the terminal value, and then you discount that terminal value back to today, but discount it for 5 times to get a $45.50 of terminal value. And you also calculate the free cash flow for first 5 years, and adding those present values together, and that will give you $10.25, and that will give you total value of $55.75. And in the year 1996, by the time that this textbook does its analysis, the Amgen stock was traded at $60.75, pretty close to your valuation. So that is a two-stage model. Very simple demonstration of two-stage model. I want all of you guys once again, before you complete this chapter, please look at 3 video demonstrations on problem solving for 3 problems that you will see at the end of the chapter, because you do need to go through very similar procedures for solving problems in your second exam. So this is a very short chapter, but you have more video to watch. That is a problem solving demonstration. I hope you enjoyed this video, and I will see you in the next one. Thank you so very much.